from Apple that will drive growth in the shares. At the same time, Ed, if we get a downturn in the economy, people are going to flock to this stock as a safe haven, right? Because they have like $170 billion in cash and equivalents, and the free cash flow is insane as well. It's amazing that this is a growth, tech growth company and also a place where people seek safety.
I think it really depends on how much has changed since the last earnings report, because the narrative or commentary from Tim Cook and Eddie Q, the CFO, was consistent with what you just said. They told us that the smartphone market, particularly in North America, was weak. The point of difference was that in the fiscal third quarter, China was a swing. It swung heavily to a gain driven by iPhone. But then the narrative changed, right? They had told us in the fiscal third that going into the end of the year, iPhone would accelerate, including in Greater China region. The third-party data that has subsequently been released contradicts that. On the cash on the balance sheet, we talk about this every quarter. Largely, I guess the story is around buybacks and returning shareholder value, because they ain't going to be out there shopping and buying something ginormous at this stage.
All right, Ed, thanks for joining us on that. Ed Ludlow there out of San Francisco. No one has a better view of the tech sector than Ed and Caroline Hyde, and they anchor Bloomberg Technology every day at noon. So definitely going to be all over the Apple story today and tomorrow from them. Definitely don't want to miss that show. For some of the sector price action this morning, let's get to Bloomberg's Abigail Doolittle. Abby, what have you got?
Well, Matt, we are heading to the best week for the S&P 500 going all the way back to November of 2022, and today is no exception in terms of that bullish attitude. All 11 sectors for the S&P 500 are trading higher. It's notable also that the index is back above its 200-day moving average. The worst sector, staples and then healthcare, those of course are defensive sectors, so that underperformance is actually risk on or supports the risk on tone. Up top, real estate, discretionary, energy, utilities. So an interesting mix, but we have basically 8 sectors trading up more than 1%. And here's the story of the week. Take a look at discretionary soaring 7%, tech up almost 6%, communication services up 5%. So those are those mega cap tech stocks that have been hit so hard since July. Well, not this week. And interesting that we also have real estate higher with them. As yields go down, those dividends look more attractive.
All right, very good point on real estate, Abigail. And of course, we're all watching those big tech gains this week as well. Stock gains, bond gains. Coming up, the market moving events that you need to be watching. That's next in our trading diary. This is Bloomberg.
About that all day yesterday.
Time now for the trading diary, what you need to be watching through next week. Apple earnings coming out today after the closing bell. Then we round out this week with the October payrolls report at 8:30 tomorrow morning. FedSpeak picks up again next Tuesday, along with more earnings from Uber, Robinhood, and eBay. Then earnings from the House of Mouse on Wednesday. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, November 2nd. Here are the top market stories we're following for you at this hour. What the economy needs next. So central banks stay on hold. Equities fly higher. Yields fall. We see what economies want more, a hike or a cut. So for biotech and industrials, maybe it's a cut. We're going to talk to Stefan Bancel, CEO of Moderna, and Blake Morit of Rockwell Automation on what high rates are doing to their sector growth and demand. For gold, maybe just no more hikes. We're going to sit down with Mark Bristow of Barrick Gold to get his take on gold demand as prices near $2,000 an ounce. From New York, I'm Alex Steele with my co-host in London. Guy Johnson is on assignment. He will be with us very shortly. Welcome everyone to Bloomberg Markets. We also get some more data dropping, factory orders, durable goods, the final read for September. So I want to go right to Michael McKee with some of these numbers. Hey, Mike, what do you got?
Well, the factory orders is a second round here because we already got durable goods orders. They adjusted a little bit, but they add non-durables. Factory orders up 2.8% after a 1% rise in the prior month. It's been revised to that from 1.2. So we have stronger numbers. Durable goods within that up 4.6%. They had been reported up 4.7%. So the non-durables component makes up a much bigger part of that. Capital goods orders, non-defense, ex-air, that's the sort of core number, goes up 0.5%. That's a tick lower than the 0.6 that was initially reported, but it all still suggests that companies are still spending some money.
Yep, which kind of goes with the data that we've been seeing. And you're seeing the long end continue to rally. You're seeing equities continue to be bid. So stay with us, Mike, because this really sets us up, right? And Guy and I were talking about this earlier, kind of what does the economy need? You look at some of the data and it looks like we need more hikes. You look at some stuff of what the companies are saying in terms of demand and you might need cuts. So we wanted to kind of debate this a little bit. And what does the economy need, more hikes or cuts? With us, Michael McKee, and Jess Menton of Bloomberg is with us as well. Jess, that's the eco side, right? Let's go to the equity side for a second. What does the economy need if you're a company or a CEO or a CFO right now?
Well, typically when you're looking at rate cuts, that's usually doesn't bode well more broadly for the stock market. If you think back to the early .com bubble bursting and then early 2001 when the Fed had those emergency rate cuts, obviously after hiking for a while there, but the market didn't bottom once they stopped doing that. That was more of when you saw more pain with earnings bottoming out. But when you're looking more broadly at earnings, even with the tech companies basically meeting expectations, but those guidance is coming in lower than expected. When you're looking at the earnings growth year over year, it's actually around 45%. It's supposed to level out once you get closer to next year just because those base effects aren't quite there. But typically rate cuts doesn't necessarily bode well just because that usually causes concerns about for especially companies looking ahead and what that means, especially with the Federal Reserve if they're concerned more broadly about the economy. But we are in the holiday quarter, obviously. When you look at that latest Atlanta Fed GDP number, it's actually a little over 1% right now compared to what we obviously saw with that gangbuster third quarter number. So we're still not going to get that final number like Mike knows until January for the fourth quarter. But if those expectations, especially with construction spending coming in weaker than expected, the guidance is kind of basically muted. But still, when you're looking at consumers, especially with Starbucks today, right, people are still going out and buying their lattes.
Yeah, so it's like some things are still okay and some things really aren't. Just look at, say, Rockwell Automation. Okay, Mike, let's get to you then. What does the economy need? Cut or hike?
More time.
Oh, no, come on, pick a side,
It doesn't need cuts at this point, and it doesn't need additional rate increases. We're pretty good where we are, I think. What we need is to give it time, the Fed's current rate, to work through the economy. The way monetary policy works, of course, is it raises the price of money, and when you go to get a loan to buy something, and that goes up, you buy fewer things, but you don't go all at once. Americans didn't line up around the bank when the Fed started raising rates to try to take out loans. That occurs over a period of time. So we shall see if we see a continued drop in borrowing and a slowdown in the economy. If not, if we still see a lot of strong growth, pay no attention to that Atlanta number yet. If we still see strong growth, then the Fed probably will have to raise rates. But right now, I think the best outlook is to take them at their word when they say higher for longer. Not necessarily higher now, but longer.
All right, fine. So it feels like then we need to price out maybe the cuts then for 2024, if that's fair. Mike, is that fair? Is the bar lower for tightening or lower for cuts?
The bar is lower for tightening than it is for cuts at this point. But I think the question is, why will the Fed cut? And Jess is right. If the Fed is cutting because we're going into some sort of recession, that's bad news for business, and you're not going to want to buy stocks. But if we did get the soft landing, if inflation comes down, the Fed could determine we don't need interest rates at 5.5%. We could go down to 4% or 3.5% or something like that and be cutting rates that way. That happened in 1994 when the Fed raised rates preemptively to cut off inflation. Inflation fell, the economy kept going along, the Fed cut rates, and the economy grew even faster. So it can happen, doesn't happen very often, but it can happen that way.
So Jess, when we talk through all the earnings calls and stuff, like I know seasonality is one story, but some of the guidance really doesn't look good, and it's so hard to understand if it's sector specific or if it's company specific. Like, who would have thought that Starbucks would have done well when everyone's worried about the consumer, and like expectations for consumers are really low, but then they're still buying $8 cups of coffee.
Right, despite things being more expensive. And coming into this earnings season, if you look at the earnings revision momentum on a 12-month basis, you really saw those expectations coming up for energy, but then also technology and discretionary. So those particularly, when you're looking at tech and discretionary, were the ones that started leading those revision estimates lower about a year and a half ago. But typically, when you look at the sell side, they tend to cut those estimates going into earnings season. But this time around, it was the opposite effect because they were trying to catch up because the last couple of quarters had been a lot stronger than expected. So now you're seeing things maybe a little bit too optimistic. But overall, when you're looking a year out, they're still seeing more optimism, and especially communication services. Obviously, that houses other big tech companies when you are thinking about Alphabet or Meta. But maybe things were a little bit too rosy coming into it, and they're trying to square that away. But overall, when you're looking at some of the growth year over year on technology, and particularly those big tech stocks, even though the guidance misestimates, those numbers are still far outpacing overall what the broader index is showing.
Yeah, it's just that growth, the question on growth, and the visibility is really murky. Guys, thanks a lot. Appreciate it. Michael McKee, Jess Menton, thank you both very much. So coming up, we'll get more insight into our question of the day. What does the economy need more, hikes or cuts? We're going to talk to Jody Gunsberg, CBOE Global Markets Head of Strategic Partnerships, coming up next. This is Bloomberg.
The real test will be on Friday when we get the employment report.
The jobs report.
The jobs number, is going to be incredibly important.
It's always important.
The labor market remains actually fairly hot.
Just, very strong. Still extremely tight.
Last month it was 336,000 jobs. We're expecting around 200,000 jobs.
The expectations are it's going to go the other way.
We are gradually seeing a slowdown in the pace of hiring.
The job gains have indeed slowed.
We'll see if that slowdown continues.
Continued moderation in the labor backdrop, even if it's uneven, I think is going to persist.
Labor market is the key right now.
Key indicator.
Key thing that investors across asset classes are going to be watching.
Everybody's trying to figure out what the underlying trend in the labor market is.
It all comes back to jobs.
We'll see what non-farm payrolls gives us on Friday.
Those are some of the Bloomberg TV guests earlier weighing in on tomorrow's unemployment report, which kind of brings us to the question of the day, which is funny because the JOLTS number yesterday was still really strong and the market kind of didn't even notice it. It was more focused on the weaker ISM manufacturing. So what does the economy need more, hikes or cuts? Here with now to answer the question, Jody Gunsberg, SIBO Global Markets Head of Strategic Partnerships. Jody, thanks for joining. Good to see you. Guy will be sad he missed you, but what do you think? Hikes or cuts?
That's a great question. I see more of a case for the hikes rather than the cuts, though leaving the rates unchanged can be really good for the opportunities in the market because what it leaves is inflation elevated for some time, letting the softer labor markets and slower growth take care of that. So with that, we see still low volatility but very high dispersion. When we look deeper into the markets, that means that there's a greater spread of winners and losers that active managers can pick from.
Right, and we've seen this very much in earnings season. It's hard to get a full sector read. Each company, some might do really well in the third quarter, but their outlook disappoints, or the backlog winds up falling, or their outlook is murky, or then all of a sudden people are buying a bunch of Starbucks coffee. So how do you deal with that?
When we look at the high dispersion, we see most of the opportunities historically in energy and tech, and most of the losing returns are from real estate and finance. So we look at that split and we think about that the fundamentals from the earnings are overpowering the macro picture. So when there's high dispersion, there's about 1.5 times greater opportunity for active managers to outperform the index. So there's about a 14% spread on average between the winners and losers with high dispersion versus only about 9% with low dispersion.
And does that just work if the Fed stays on hold? Like if they keep hiking or cutting, doesn't the macro take over again?
The macro should shift, but not for a while, because generally when there's high inflation, there is stronger growth, and with that we see lower volatility, and we also see higher dispersion persist. So in this environment, we'll continue to see opportunities in energy. It's the most sensitive sector to both the macro and fundamentals. It's sensitive to the dollar. Oil is inversely priced. It's sensitive to inflation, but it's also super sensitive to the geopolitical risk and to any supply shock like a weather event, like a hurricane. So we see super high opportunity there. And then with real estate in real assets, because of its segmented return opportunities by geography and by type.
So clearly not commercial real estate.
Well, it would be commercial real estate versus something like residential or retail. So when you can find those pockets of opportunities because of the local markets and the types, that's where you can get your extra returns from active management.
Okay, so then on the downside, you're mentioning financials. That's not going to work. What don't you like? Or it doesn't work right now?
Yeah, generally with the high dispersion, financials don't really work. I think the market is largely brushing off these interest rates. I mean, you saw there was very little action after the Fed's expectations of no rate change. So I do see, again, more opportunities in energy, tech, and with the real assets, commodities, infrastructure, real estate, all of these sectors that are driven by high inflation.
So what's interesting, you mentioned infrastructure, is I feel like what we've heard, and I just want to focus on Caterpillar, for example, that you have a structural shift in this industry from nearshoring, the SEMI Act, the IRA. Like there's stuff. There's money that's going to be spent, and a lot of money in like 10 years. But right now, the visibility of the next 6 months is really low, and the backlogs are deteriorating. How do you manage that?
Yeah, the volatility is low, but the opportunities in the earnings fundamentals, as you just described, are variable. So in order to manage that, I think it's hard for any single company to fight the tide of the sector moves. So sticking with the sectors, and then only where managers have conviction in the individual stocks, they can go long or short the stocks, and then opposite direction in the sector so that they can get those spreads, generate alpha, use leverage, and manage the risk with derivatives.
So if earnings matter more than fundamentals, I mean, I'm paraphrasing and taking words out of your mouth at this point, but does that mean the bond market and the equity market can finally move differently?
Yes, I believe that it's not just the bond market and the equity market, but looking inside of the capital structures, because again, the earnings fundamentals are so important in this period of high dispersion. So, I think sometimes people forget in looking at bonds and stocks as separate asset classes that they're actually, in many cases, coming from the same company. So evaluating the risk of those companies and seeing where do you want to play on that capital structure.
Right, and is it credit or is it equity? Like, where do you get the most return right now in this environment? Depends on the company.
It depends what company, but I say equities, because equities generally present higher risk, higher returns. We're seeing tons of opportunity in the risk of sectors and companies versus the market as a whole. So I'd play the equities, and I'd play them active and extra active with the hedge funds going long and short.
Extra active. I think that's the first time I heard extra active. I like that. All right, Jody, thanks a lot. Jody Gunsberg, SIBO, Global Markets Head of Strategic Partnerships. Thank you so much. All right, still ahead, Barrick's Gold Rush, the gold producer beating profit estimates on higher production and lower costs. We're going to talk to Mark Bristow, Barrick President and CEO, always outspoken. This is Bloomberg. Well, Barrick Gold beating estimates in the third quarter, had solid production and improved costs. The stock is up by about 0.2%. Mark Bristow, Barrick Gold President and CEO, joins us now. Mark, great to see you. Always a pleasure. I mentioned sort of improved production and lower costs. Can we just focus on costs for a second? What's coming down? What's sticky?
So, I mean, a little bit of both, Alex. It's nice to see you again. And as you know, in mining, when you increase your production, you drive your costs down. So, the pressure remains from oil and some of the oil-related consumables we use, but as far as logistics and some of the other more sort of routine costs, we've seen a flattening and in some cases slightly down.
Oh, okay, wow. Well, that's something. So you're seeing actual disinflation in some categories.
Oh, yeah.
So, okay, that's one side. Let's go to the production side. You've had some, I don't want to say issues because they're not issues, but overall year-end gold production target, you're going to probably miss what you had forecast. What's going on? Where are the operational constraints?
So there are two big things in our growth profile. Well, actually there are three, but the first one is we, as you know, back in 2018, we set out to re-establish Pueblo Viejo, which is a very large gold mine that was about to close in 2021. We've now got that permitted. We've invested in the expansion of the processing facility. We're busy ramping it up, and we had some issues with our flotation cells that were supplied by FL Schmidt, and also a portion of a conveyor belt collapsed on commissioning. We've re-engineered them, and the cells we'll have done by the end of the year, and the conveyor belt, we've got an interim mobile conveyor belt established already. It'll still produce at over 800,000 ounces next year. It's that ramp up that'll impact this year's production. And then the other one is the delay in the record of decision for our Gold Rush project in Nevada. We've just received that notice on last Friday, and so that'll come. It'll move ahead now, and those two projects are big drivers in Barrick's profile going forward.
I see. Okay. Talking about project delays, this does not actually affect you at all, but I want to get your thoughts on it, and that's what's happening with First Quantum in Panama. So kind of all of a sudden, lawmakers have now voted to repeal a new contract with First Quantum Minerals. Some of the stuff on the table is like no new mineral rights ever. Are we in a new era of geopolitical risk for miners, a new era of governments trying to take more of a piece of the pie? I know you deal with this and you've dealt with this for decades, but is this something different?
No, it's not different. And, Alex, you and I have spoken about this license to operate. Your most important stakeholder as a miner today more than ever is the government, your host government. And we as an industry need to invest in that more heavily. Shareholders benefit from a strong social license or license to operate. And sometimes, we go back to the old way of thinking where, you're doing a country a favor by investing in it. And, that's something I've learned over my career. It's tough when it goes against you, as we witnessing today. It requires hard work, and you can't manage this from some 16-story head office. You've got to be on the ground. You've got to, it's a relationship business like most businesses have become today. And young people want to be part of it. They want to see you doing the right thing. It's not just a case of exploitation. It's got to be investment with benefits for all stakeholders.
So I guess that brings me to the question of M&A. We have Newmont just closing its deal for Newcrest next week. First Quantum obviously in a really bad spot. Are there opportunities for M&A? Is it going to be just growth to buy versus organic growth? Is that just the way forward? We've seen that in the oil industry, for example.
I think in the oil industry, some of those deals have been very opportunistic, and that's the best M&A you can do. I started the new Barrick on the back of three very aggressive at-market acquisitions. And then we've chased all these recent acquisitions, but it's hard to create value at the top of the market. M&A is all about ad hoc opportunity that creates value. Otherwise, all it is an opportunity to get bigger without being able to deliver the value to your stakeholders. So, I think we'll retain that strategy, and I think the flip side of that is in this 5 years, we've replaced everything we've mined. We've got a 30% organic growth. We don't have to pay a premium for that. Embedded in our next 5 years, and so we've got lots to be happy with. We've got no debt. No debt, independent of the market. The stories I always tell you.
Mark.
And lots of opportunities organically.
So to that point, we're asking all our guests today what the global economy needs more right now, hikes or cuts? And I'm just wondering what your take is on that. I know you don't have any debt on the one hand, but you are levered to the gold price, for example, which could probably do with some rate cuts. What do you think?
So the global economy is in a very difficult position because it ignored the pressures of inflation and continued with free money printing or quantitative easing. And then when it worked out that it was wrong, it jacked the interest rates up at a very rapid rate. And now it's caught because it actually needs to increase interest rates, but it can't because it will destroy the global economy. And it can't drop them. So you're in that stagflation band. The equities are too expensive, generally across the world. The emerging markets are in real stress created by a very selfish Western economic bloc, the developed economies. And so, and on top of that, a thick spread of chaos. So, soft base metals, you see the base metals companies worrying about how they manage the future.
And China.
The whole global economy is under pressure, so that's good for gold. But it's a difficult time, and this is the time, Alex, when you've done those M&A deals that are very expensive. They're hard to get through the trough. So, and I think that's why I feel very good about our strategy in Barrick, and we're extremely well positioned because M&A is always there. It's when you take it on, when you take the opportunity is the critical thing. And
Mark,
sometimes it makes money and sometimes it doesn't.
We got to leave it there. Coming up against a hard break. Appreciate you. Thank you so much, Mark Bristow, CEO and President of Barrick Gold. Coming up, Moderna CEO. This is Bloomberg. Welcome back to Bloomberg Markets. I'm Alex Steele, and Guy Johnson is back. I missed you for the half hour. Mark Bristow missed you, who's very sad to not have the chance.
I'm sad to have not seen him. Yeah, no, I've scuttled back over from the Bank of England in the rain, and we'll play my interview with the Governor out very shortly. There's a few interesting little tidbits in there. We'll wait and see exactly what we get out of it. But yeah, I think the Bank of England today, to a certain extent, just reiterating the message, no cuts. The Fed talked about being strategically patient yesterday. Kind of feels the same for the Bank of England.
Yep, everyone on pause, and then kind of the now what, which is our question of the day. Is it a cut? Is it a hike? What is it? What does the economy actually need? So we're going to get to that throughout the next hour and a half. We are currently an hour into the U.S. trading session. Stocks on the front foot. You have a big coming into the bond market. Abigail's tracking the moves. Abby?
Yeah, we have a pretty bullish, not just day, Alex, but take a look at this week. We're looking at the best week since November of last year, up 4.3% for the S&P 500. So lots of strength, having to do with investors thinking that the Fed is on pause and maybe that there's not another hike, even though room was made for it. It's not just the S&P 500 today, though. It's a broad-based rally. Most indexes are up 1% or more. You can see the NASDAQ is higher, the SOX up 1.8%, the Russell 2000 small cap, which is so beaten down, up 1.4%, and then the Goldman Sachs unprofitable tech, it's surging up 5.5%. Its best day since April, earlier the best day of the year. I don't want to say that's a dash for trash, but it's certainly FOMO. Now, there's two reasons for this FOMO, well, at least two reasons. Let's take a look at the yields that Alex was looking at. We've looked at this chart before. This is the 10-year yield, basically hugging its 50-day moving average. This range has been really reliable. Looks like we're dropping right down to where the 50-day moving average is, 453. Will it hold? This range suggests that yes, it will, and then send yields back higher, but let's wait and see whether or not that happens. As for stocks, that of course, there's the idea that maybe valuation looks better, a little bit more liquidity. Here's Apple, of course, reporting after the bell. This is what it looks like for stocks, and this is why folks are buying, because this has been pretty reliable by the dip right to the top of the range. The question is, we're now pretty much at the top of the range. Are we going to see stocks come back in? Well, Apple will, of course, be a big key, and I would suggest, Guy, it's not just Apple's long-term chart, but lots of long-term charts suggest that probably some more selling is ahead, but today and this week, all eyes clear, FOMO, risk on, bulls are in charge.
Yeah, we'll see whether post-Apple that actually holds. Such a critical part of the market. Abigail, thank you very much indeed. We need to talk more about this. It's a huge moment. We've obviously seen a lot of the tech companies already reporting with mixed results and mixed market reactions. Where are we now? 32 minutes past the hour on the West Coast. Time for the startup. We need to cover this story. It's definitely one of the top tech stories from the Bay Area and beyond. Silicon Valley is starting its morning. Another lovely morning. Look at that bridge. Fantastic. Bloomberg Technology co-host Ed Ludlow joins us now. Ed, this is one of those critical moments. How much pressure is there on Apple here?
Well, it's telling that Guy Johnson ran back from a conversation with one of the leaders in world monetary policy to talk to me about Apple, because that's been the story of this week, right?
To be fair, the interview was done. The interview was done. Let's just not.
No. Reframe it.
I have come back to talk to. Yeah, you can make hand gestures, but I've come back to talk to Ed. He is far more important. Well, maybe
it's not about
Alex
talking
Steele,
to me. It's about talking about Apple.
Ed Ludlow.
It's about talking about Apple in a key week, because we went into this earnings season knowing full well that Apple's on track to report its fourth straight quarter of sales declines. You have to go back 2 decades to see that kind of slump. And the hope was that the iPhone 15 would resonate with the consumer globally, but particularly in China. And as you guys know, that hasn't been the case according to third-party data. So we could wake up Friday morning and the world be really worried about the global economy and strength of the consumer, which has been so resilient in the US because Apple gives us a contradictory sign through its lens of smartphone and Mac.
How are traders positioned for that? I mean, we've been building up to this for a bit. There's been product releases. There's been great Bloomberg reporting on it. Like, how much of all of this story is priced?
Well, mechanically, through the options market, they're bracing. But what I would also say is, remember going into this, we talked about the kind of 5 mega caps accounting for all of earnings growth on the S&P 500, right? So across the 5 mega caps, 34% EPS growth was forecast. And if you strip those out, the S&P 500 was forecast to have flat EPS growth. Of those 5, the one exception to the rule was Apple. I think it's forecast to have something like 8% EPS growth, which compared to the big numbers that Microsoft, Alphabet, Nvidia, etc. Are expected to put out, it's minute. So that's why I framed it that way about Guy running back from the BOE. From a weighting perspective on indexes, this is really important, but also it contributes to kind of the growth story going into 2024 for the whole of publicly traded US corporates.
It is the size of a small economy. Like, let's be honest about this. This is going to have a big impact. The Bank of England didn't do very much. Let's see whether or not we actually see some action from Apple overnight. Ed, fantastic setup. Thank you very much indeed. The conversation will, of course, continue. Ed Ludlow, Caroline Hyde, Bloomberg Technology. That is coming up in around a little less than 90 minutes' time. Let's go from tech to biotech. Moderna is trying to adjust basically to the post-pandemic era. The vaccine maker under a little bit of pressure today. This after reporting a larger than expected loss. It's taken a $3.1 billion charge. It's basically writing down excess COVID shots. Alex and I sat down with the company's CEO a little earlier today. We started by talking about that write-down.
It's really a one-time restructuring. As we talked about at R&D Day back when we spoke in September, we said we're going to right-size manufacturing because, we built manufacturing to deal with a COVID, pandemic. But now that we're going back into endemic setting, we don't need as much capacity. And our cost structure was too high. So we're taking a one-time hit. There's a tiny bit of it that will be in Q4 just because accounting rule, $200 million of that. But that's a one-time thing. With this, we have a right size to deal with a company. And then we'll be able to grow with the new plants that we are building in Canada, in the UK, and Australia. So we're going to be good.
Stefan, just one more piece on that, though. Do we know why the COVID uptake shot has just not been as good? And I'm also wondering if there's been any sort of shift because of how the U.S. pays for it. Like, it's not the government, it's now an insurance. And has that kind of changed the COVID take-up?
So if you look at the COVID market in the U.S., it's trending a little bit above last year. I think it's still too early to tell where it's going to finish the season, because we're hearing that there's still a lot of desire to get vaccinated in November and December. So let's see. But I don't think that it's a commercial market has changed things, because for the consumer, it's still free. If you're insured, you walk into a pharmacy, you get your shot, and you walk out. You don't pay anything of copay. So I don't think the fact that it's commercial now changes anything.
Stefan, you are, though, going to be leaning much less now on what is happening with COVID and focusing more elsewhere. But nevertheless, I do wonder whether the scaling back of the COVID side of the business means that ultimately you're going to struggle to generate the top line, the revenue necessary to make that transition to the next phase. How would you answer that kind of a question and that kind of concern at the moment that exists?
Sure. I think there's two questions people have. First is, where's the bottom of COVID? And we think, because we announced this morning that we think the sales next year will be around $4 billion. Mm-hmm. We think that's what's going to be the base of COVID. And then it's a new product. As you know, we have a platform. We talked about it many times on your show. We have 6 products in phase 3. As you know, the biggest issue the industry has is what's next. Mm-hmm. Well, at Moderna, because of a platform, 6 phase 3, we're going to launch RSV next year. We have flu product with great phase 3 data, flu COVID combo, the cancer product, launching in 25. So if you think about it, we think that we have a 4 billion-ish of COVID base, and then you're going to layer on that new products coming, and those products are very, very close, starting in 24.
So you have to get there, though, first, and you're planning to spend like $25 billion over the next 5 years. If you don't reach that $4 billion base for COVID shots, when do you start considering cutting your other programs?
Yeah, so we look into this if we have to. I think it's more for a 25 time frame. I think in 24 we're pretty comfortable with the numbers. The other piece about RSV we just spoke about. RSV, we have a best-in-class product, we believe, with very high efficacy, very good safety, and it's going to be very good because it's pre-filled syringe. The other products on the market today have many, many steps of preparation. As you know, in pharmacies, you even have workers walking out on strike because it's too complicated, the workload is too big. And that's a big market. Just on the Q3 sales, the 2 players on the market reported $1.2 billion for the quarter, Q3. So if you think about this market, that's a brand new market. We might be the leading company once we launch because we believe we have the best product.
Stefan, the biotech sector is getting hit pretty hard right now, certainly within the stock market. And I'm wondering when you think that phase is going to bottom out. And I'm wondering as well whether or not you think there are opportunities within there. You're doing quite a lot at the moment with what you've got, but I'm wondering as you look across the landscape, whether there would be potential bolt-ons at current valuations. Are you going through that process at the moment, thinking of how synergies, how opportunities could evolve?
Yes, very much so. I mean, we bought a company in Japan during the Christmas break last year. We've done a couple of deals this year, a company in Germany, a company in the US. So we think there's very interesting companies out there. As you say, the environment for biotech is very hard now. And I think as long as the long-term rates stay high, biotech, because it's many, many years to launch and it's quite risky, a very different cost of capital than it used to have when interest rates were close to zero. So I think that's the issue that biotech is facing as an industry. So as you say, there's some good companies that maybe went public too early, that maybe have not the right size of burn compared to their ability to raise money. So it gives a company like Moderna the ability to really size opportunity like we have done and will continue to look into.
That was our interview with Stéphane Bancel, Moderna CEO. And Guy, I jokingly then asked him in the next question. I was like, are you in the wrong drugs?
Yep.
Like, should you be making something for weight loss, etc.? And that kind of goes into Novo Nordisk. Like, they keep delivering these numbers, Wegovy and Ozempic, and that just keeps adding to the stock upside. Meanwhile, Moderna, lowest level or falling the most since 2020.
Yeah, it had its peak early. It's now having to right-size, resize the ship, figure out exactly what the long-term business is going to look like. I thought his comments, though, at the end there, talking about the idea that in this race environment, a lot of biotechs are going to struggle. A lot of biotechs that maybe went to market too early and are now going to struggle with their cash burn. I thought that's really interesting. The ripple effects, the impacts of higher rates is working its way through the system. And that's just one great example of it.
Yep, and you have sort of the macro on that for the whole sector, and then it's also going to be micro, like when did companies finance? Like what yield are they at? When do they have to come back to the market, etc. So that's going to be quite interesting. And speaking of, we're going to talk more about industrials and the backlog. Like if there's one sector and one thing we learned from Caterpillar is that it's really tough out there to be an industrial company. Rockwell Automation will be joining us next. So they beat on earnings and sales in the third quarter, but it's really about the slowdown that we might see ahead. They're an early cycle play, early cycle indicator. Blake Moret is Rockwell Automation Chairman and CEO. He joins us next. This is Bloomberg.